Anthony Grasso here, bringing you financial news that you could use. In this video, I'm going to do a stock analysis on Snowflake, and I'm going to go over the Q2 results. Is this young cloud-based company that still has to prove that it can even break even worth investing in right now? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, analyst projections, and financials, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribe and hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. And as always, folks, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so what is Snowflake? All right, Snowflake provides a cloud-based data platform in the United States and internationally. The company's platform offers Data Cloud, which enables customers to consolidate data into a single source of truth to drive meaningful business insights, data-driven applications, and share data. Its platform is used by various organizations of sizes and ranges and industries. The company was formerly known as Snowflake Computing and changed its name to Snowflake Incorporated in April 2019. It was incorporated in 2012 and is based out of Bozeman, Montana. That's pretty cold over there. All right, so let's look at some of the big news of the company right now. So the biggest news that came out yesterday was the Q2 results. Shares of Snowflake jumped 20% early Thursday, a day after the company released the Q2 results that beat on the top line. The data platform reported that there was $497 million in revenue for the quarter, more than the $467 million expected by the analysts. Now, analysts from the Canaccord Genuity said that this was just another excellent quarter for Snowflake, and though they said executives offered a little caution about the uncertain macroeconomic environment that we're in, it seems like it's business as usual at the company. Now, Snow shares aren't really cheap, that they wrote in the Thursday note, but this is a category leading company that's growing far faster than almost anything else in software and is doing so nicely profitability with improving the cash margins. Loop Capital analysts were also encouraged by Snowflake's exceptionally good results. They said the company's success was driven by continued traction up market, strong execution, ongoing data warehouse migration to the cloud, and the addition of more products and use cases. With this in mind, they believe Snowflake is still early in its massive market opportunity, particularly with large organizations that are undergoing multi-year initiatives, migrating workloads to the cloud, they wrote in the Thursday note. Now, Snowflake said it anticipates product revenue will be between $500 million and $505 million in its third quarter, and between $1.9 billion and $1.2 billion for the full year. So this is definitely really great news for the company, and it has skyrocketed since then. So now that we looked at the biggest news article that came out, let's go ahead and look at some of the fundamentals of this company right now. All right, well, the stock is currently trading at $191.51 a share, and it currently has a current market capitalization of around $60.5 billion. Now, the company is projected to have around $2.01 billion of revenue for its fiscal year of 2022, which is an increase from $1.2 billion in revenue for 2021, with the 2022 earnings are forecast to be around negative $742 million. That's kind of concerning, right? Now, the company's high growth revenues are projected to significantly increase over the next few years to around $4.44 billion by the end of 2024. But it still is projected to have negative $841 million in negative earnings. So even though revenue is forecasted to significantly increase, its earnings are negative and are still projected to stay negative and increase the negativity over the next few years. Can this company change that over the next 2 years and have analysts start increasing the earnings potentials? Well, we have to wait and see. Now let's go ahead and look at some of the key measures of the company right now and do some analysis work. All right, so the most appropriate, let's look at the valuation analysis. Now, the most appropriate valuation measure for Snowflake is the price to sales ratio. The price to book ratio is excluded since it most likely underestimates the company's book value by overlooking hidden assets such as intellectual property. While the price to earnings and the price to earnings growth ratios are not meaningful, therefore, Snowflake seems highly valued with a price to sales ratio of 35.9 times. That is the highest in the IT services industry, who only averages 3 times that price. So now when you look at the price to sales ratio versus the fair ratio, and this is the expected price to sales ratio taking into account the company's forecasted earnings growth, profit margins, and other risk factors, it does seem expensive on that note, because the fair price to sales ratio is 22.1 times and it's trading at 35.9 times. Now, when you look at the fair price versus the fair value, now this is when you're looking at future cash flows. For this estimate, you use the discounted cash flow model, and it's below fair value. It's trading, we put an estimate of around $258.47 a share for the fair value with the discounted cash flow model. Now let's look at some of the profitability numbers of this company. So it does lose money on an operating basis. Snowflake appears to be an inefficient company. While its profitability is among the best on a gross margin basis, its bottom line, the net margin, is among the weakest in the IT services industry. Now, it's currently unprofitable, and it's not forecasted to be profitable over the next 3 years. Now, let's look at the Snowflake. Like most of its peers, they don't pay any dividends, so we don't have to worry about that. And then let's look at the growth of the company. I know CNBC, I'm going to get another service provider because CNBC really doesn't update numbers very often. But you can look at this for their average, industry average, and sector average, and S&P 500 average for these numbers. All right, so looking at the growth rates analysis, all through earnings at Snowflake grew over the past 12 months. They failed to keep pace with the growth in revenues. This may mean the company is becoming less efficient at using its resources. However, this result was better than that of the average company in the IT services industry. Now, the earnings trend is not good right now. Snowflake is unprofitable, and losses have increased over the past 5 years at a rate of 36.1% per year. But it does have high growth revenue. So its earnings aren't good, but it has great revenue. They need to really fix that. So the revenue at 34.8% per year projected increase is forecasted to grow faster than the market average. And finally, when we look at the financial strength of the company, because that's kind of important with a company that's unprofitable, it does hold a substantial amount of cash and cash equivalents on its balance sheet. Now, these liquid assets can be used to fuel growth, pay dividends if it so chooses, and to limit financial risk. Now, its short-term assets of $4.3 billion exceed both its short-term liabilities of $1.4 billion and its short-term liabilities of $1.4 billion and its long-term liabilities of $201 million. Now, they're basically debt-free, and they have not had any significant debt over the past 5 years. And then when you look at the cash runway, because this is kind of important, if they don't have a cash runway, they might dilute shares in the future. So while unprofitable, Snowflake has sufficient cash runway for more than 3 years if it maintains its current positive free cash flow level. And the forecasted cash runway, it has sufficient cash runway for more than 3 years due to the free cash flow being positive and growing by 89.6% per year. So I'm not really too worried about them diluting the shares over the next year or two. They have enough money on hand to make expansions. But it's important to note that insiders have bought more shares than they have sold in the past 3 months. But when you look at 3 months to the past year, insiders have only sold shares. So it's only been the last 3 months that insiders are buying back into the company. So what did the analysts say specifically regarding this company? All right, well, the average analyst consensus is a buy recommendation, with 23% saying strong buy, 46% saying buy, and 25% saying hold. Now, the average price target over the next 12 months is $200 a share, with a high estimate of $530 and a low estimate of $110. Now, if we go over some of the analyst reports, and I'm not going to spend too much time on this because these analyst reports haven't really updated since the earnings report came out yesterday, but the Street Quant Ratings has a sell recommendation on Snowflake. And they rate it as a sell because there's some concerns which they believe would have a greater impact than any of the strengths and could make it more difficult for investors to achieve positive results compared to most of the other stocks they cover. Among the areas that they feel are negative, or one of the most important, has been the generally disappointing historical performance in the stock itself. Also, the CFRA report has a hold recommendation on this company, and it remains hard to refute the breakneck pace of growth, well-respected management, and seamless usability of Snowflake's data platform. But the CFRA's enthusiasm is tempered by the limited investor appetite for pricey stocks currently. Secondly, recent quarterly callouts, platform enhancements, modified selling motions, and choppier data consumption patterns at larger customers signal traditional providers could be more difficult to replace than originally expected. Now, prior conducted analysis suggests performance favors incumbents for bigger workloads, often linked to higher dollar clients. Moreover, they say that the Streamlit was acquired to integrate the Python programming compatibility for Snowpark, which remains an existing feature for other cloud data providers. Okay, so let me bring it back over here. So am I a buy, hold, or sell recommendation on Snowflake? Well, I definitely need to talk about my thoughts on this one. This is an unprofitable company that has a high growth potential. So here are my thoughts. Now, I can't lie, Snowflake's second quarter was an excellent one, as revenue and earnings per share came in well above the people's expectations and management's as well. This was due to Snowflake's making traction up market. Snowflake has success in the ease of setting up and trying out the Snowflake platform. Now, this requires low upfront costs due to the company's consumption model. Now, to summarize the second quarter, revenues of $497 million. That's an increase of 83% year over year. Now, the product's sales showed impressive revenues of $466 million, also representing an 83% year over year increase. Now, financial services was the greatest contributor to revenue, but all the other divisions posted a healthy growth as well. Now, customer count growth remained strong, especially within the company's base global of 2,000 customers. That grew by 12 more customers in the quarter, and although has an average of 12-month trailing product revenue of 1.2 million. Now, Snowflake reported quarterly GAAP losses per share of 70 cents per share. That was better than the forecasted due to the product revenue's outperformance. Now, Snowflake's third quarter outlook includes year-over-year growth in product revenue at a midpoint of 61%. Now, fiscal year 2023 product revenue is guided by year-over-year revenue growth at a midpoint of 6%, an increase of the previous guided 66%. And non-GAAP operating margins are expected to be 2% in the third quarter, and for the overall year, headcount remains the biggest investment in the business, as the company has already added about 1,000 net new employees this year to date. Now, I do like their strategy to keep the headcount up because they need to continually increase its customer acquisition. That might pay off in the long term because this might create a long-term customer stickiness. So let's examine their business model for a minute and their strategy to get a feel for if this company is worth it. Now, as companies continue to move their data to the public cloud, they might see some obstacles, including compromising performance of data queries, creating hefty data transformation cost, and yielding wrong data. This is where Snowflake seeks to address those issues with its platform, which gives all of the users access to a data lake, warehouse, and marketplace at various public clouds. Now, the traditional model has been recorded in and accessed through a database. But in the cloud, there's need for companies to access that data from multiple databases in one place. This is where a data warehouse is helpful, particularly in creating artificial intelligence insights. Data lakes solve this problem by storing raw data that is ingested into the artificial intelligence models to create insights. These insights are housed in a data warehouse to easily queried. Snowflake offers a data lake and warehouse platform which cuts out the significant cost of ownership for the enterprises. Now, some argue what's more valuable is that Snowflake's platform is interoperable on numerous public clouds. This allows Snowflake workloads to be performed for its customers without significant effort to convert data lake and warehouse architectures to work on different public clouds. It is safe to argue that the amount of data collected and analytical computations on that data in the cloud will continue to dramatically increase. Now, a bullish analyst argument is that these trends should increase usage of Snowflake's platform in the years to come, which will in turn strengthen Snowflake's stickiness and compound the benefits of its network effect. Now, I do think that Snowflake has massive future growth potential and should emerge as the data powerhouse in the years ahead. So based on all of that, I am a buy recommendation on Snowflake with a 12-month price target of around $200 a share. I would wait for the current news to subside and buy the next dip. I can sum it up by saying it's a flawless balance sheet and slightly overvalued right now. Now, it is a young company, but it still has to prove itself that it can break even, and that's very important to me. Investors are aware that the company needs time to develop the business. This makes the current period somewhat uncertain for the equity. This will definitely remain a volatile stock for investors, and they might have to wait a longer time frame before reaching the goals of what this stock can actually do. Traders, on the other hand, can use the volatility to amplify increases in their positions if they get in the right trend. And short-term investors out there that want to trade the swings, this might be a perfect one to keep on your radar. Now, if you're a bull, the arguments are as follows. Snowflake's cloud could remain the only multi-cloud offering of its kind for much longer than anticipated, allowing it to increase its top line more than minimal price pressure. Now, Snowflake could move into a subscription-based model from a usage-based model, boosting its monetization of its products. And Snowflake could expand to other multi-cloud data needs, pushing the spending per customer to greater heights. Now, the bear argument, on the other hand, so that's what the bulls say, what the bears would say was, well, other multi-cloud data providers may emerge to compete with Snowflake, or an in-house data warehouse at Amazon Web Services or Microsoft Allure could potentially adopt a multi-cloud strategy. Now, that's definitely most likely what could happen, and I believe that Amazon could possibly try to do just that. Now, Snowflake could fail to expand its data sharing network extensively, leaving it vulnerable to competition with larger networks. Now, migration of existing workloads to the cloud could occur at a slower pace, extending the length of Snowflake's unprofitable years ahead. Now, other risks are the capital-intensive nature of this business. That's why earnings are so negative. It's capital-intensive. An inability to maintain its pace of clients, ads, or expansion could reduce future operating leverage and negatively impact the estimates, and this could tank if they still don't get their stellar growth. So investors are projecting in the stock price that it's just going to go to the moon. Now, while today Snowflake benefits from being unique in its multi-cloud platform strategy, it's possible that new entrants or even public cloud service providers will encroach more on the company's offerings. Nonetheless, I think Snowflake is well equipped right now with a fair head start that will keep the company ahead of the competition for the long run. But what are your thoughts? Please leave your comments down in the comments section below. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell for your daily stock reviews and recommendations from an unbiased source. Until next stock update video later today, folks. Ciao.